Hi everyone, and thank you for joining us for our fourth focus session in this series. For those of you who are unable to join us for last month's session, my name's Siobhan Sada. I'm one of the 4 accounting principals here at Count Plus One. Today we're lucky enough to have Chad Hohnen, who's one of our senior financial advisors here, and he's going to be presenting on the topic, when life gets in the way, how to plan for the worst. Now, earlier on this year, our leadership team spoke about having all principals individually sit down with our financial planning team to review this exact topic for ourselves. So I personally went through this process with Chad, and I found it a great experience to have somebody in the field speak to me about the choices I have, particularly with insurance. Now, just before I hand over to Chad to start this session, I just wanted to let everybody know about a giveaway that we have for participants in the December Focus Seminar. So to be eligible, you'll need to register and then ask a friend to register. Then what we'll get you to do is email us at womeninfocus@cp1.com.au and let us know of you and your friend who will be attending. So we've been given the ability through a foundation that we're affiliated with to give away 5 lots of $1,000 to any given charity of your choice. So we're going to give it away to the first 5 registrants and their friends. We'll talk about it a little bit later, but what I might do now is hand over to Chad and he can kick us off for today. Thanks, Chad.
Thanks, Siobhan, and thanks for everyone for joining us here today. Look, when most clients come and see us, it's really about trying to build a wealth plan, and insurance is probably the last thing, that they're thinking about. But for us, it's actually quite a critical aspect of the whole wealth plan, because every single plan that we put together, unless you're essentially retired, relies on your ability to earn an income. And if you didn't have that ability because of illness or injury, trying to achieve all of your financial goals can be quite challenging. So today what we wanted to do was, give you, there's a fair bit to get through today, but just give you the basic information, but also sort of discuss about some statistics, but also some key things to look out for when considering, because most individuals may have some cover through their super plan, what to look out for and how to consider what you need. So really with that said, the 3 desired outcomes that out of today was, for you to understand why we recommend to our clients to put in place a risk mitigation strategy as part of their wealth plan. For you to have a better understanding of how you can protect yourself and your family in case you cannot provide for them, and provide you with the required information to allow you to assess if your current risk protection strategy is right for you. And I suppose that last point is really key after today, for you to go home, think about, review your own circumstances, and if you're not quite sure you've got the right plan in place to get in contact with us. So look, the presentation will go for 20 to 25 minutes, and then there'll be a Q&A session straight after the presentation, as it has been the last couple. But I do encourage you to ask questions, even if you don't have time today. You'll have our contact details to reach out afterwards. Look, I won't spend too much time on this slide. It's just a disclaimer. Just look, in short, basically what we're saying here is that, this presentation doesn't take into consideration your own personal circumstances. So I do encourage you, if you are thinking about making some changes, do have some questions, to get in contact with us straight away. Okay. Our primary objective as a financial plan is to try and help you build your wealth. That's what we do. But most plans, as I mentioned before, are dependent on you continuing to earn an income. So ask yourself this one question and think about it right now. If tomorrow you woke up, what would happen if you lost your ability to earn an income? Would you still be able to put food on the table? Would you still be able to pay your mortgage? These are the things that we need to consider as part of an overall risk plan. We do our best to protect our clients from market volatility. And what we do is, we're financial planners. We're here to try and help you build your wealth. And unfortunately, as we've seen recently with COVID-19, that it's very challenging to sometimes protect against market volatility. But what we can do is always protect your wealth. And what I mean by that is, if the worst ever happens, is then, in the event that you couldn't work again, or the tragic circumstances that you were to pass away, we can ensure that if that does occur, that there'll always be money coming in, so you can continue to pay off your mortgage and pay for the ongoing living expenses. Again, our role is to try and build your wealth plan, not to sort of put in place insurance, but it is one of the most vital parts of any wealth plan we put together, making sure that if you don't have the assets to self-insure, that there's something in place, so that if you can't work again due to illness or injury,
Sorry, Chad,
there'll always
2
be money there for you.
Chad, sorry, 2 seconds. We've just had a couple of people write through saying that they're unable to see your slides. What we might get you to do, you just want to stop presenting and then start again, and hopefully that'll fix the glitch for those couple of people.
Right, okay. Let's have a look. Sorry, Rod. Can we see?
No, some people are still saying it's not working for them at the moment.
Can you see Siobhan?
Yeah, I can see it. I know a couple of people are still writing through saying they're having a couple of issues.
I'm not sure.
What we'll do, Chad, let me just get Barry to share his screen, and then that way, if it's
Okay.
yeah, perfect. There's still, no, that's all right. Okay.
We right?
Give us a
Can everyone see?
Give us a minute. Sorry, Chad. I know this is cutting into your presentation time. You've already.
That's all right. We can.
Thanks, guys, for bearing with us. All right, that should be it. I think. There we go. Can everyone see that now? Perfect. Yeah.
Okay, we're good. Excellent. Sorry about that, guys. I do apologise. I believe we got up to this slide here, so I'll just continue on. So, as I mentioned before, it's all about building our wealth, but just with something else to consider. I mean, I think as Australians, what we do, and it's just sort of ingrained to us, is that we always, go and insure our car first, our home, and other possessions. But why do so few of us insure ourselves? And if you're probably thinking the same question, you're not alone, because a recent Rice Warner study suggests that 42% of Australians are either underinsured or have no insurance at all. So it's just something to think about, because really our ability to earn an income is our greatest asset. We are our greatest asset. So that's why it's so vital that we have some sort of protection in place. In the event that we can't work, there's always money coming in. With that said, a lot of people, I think, get a bit concerned about insurance. And what I just really want to emphasise to you with this slide is that insurance is only there for a period of time. And you can see here with this particular slide is that at stage 1 and 2 is when you really need cover. And that's because in that particular stage in life, you're sort of starting out, you're probably not earning as much, but you don't have as much in assets. And, if you do have a house, you've got quite a large mortgage, and then the kids get, young. But as we get older, is that the need for life insurance does start to diminish. You can see here, because what's happening in these stages are the kids are getting older, your wealth is building, your mortgage is less. And the whole point of insurance is it just needs to be there for a certain period of time. You don't need to hold it for life. And that's what we just really want to emphasise there, because a lot of people do get concerned about the cost of insurance. And what we try and say is, look, it's there as a protection strategy for a period of time, but hopefully, we can build your asset position to a point later down the track where you don't need insurance, or the level of cover that you originally took out, you no longer need. And that's where a lot of people do, I suppose, don't take a proactive approach with insurance. It's not a set and forget strategy. It's really about making sure that you're looking at levels of cover every year and whether they're right for you, because the last thing you want to be doing is paying more to an insurance company you actually need to, and that could be going towards building your wealth. I'll never get sick, so I need to worry about protecting myself. Well, look, I think a lot of Australians, we think about, you hear about stories about people getting sick, but then, actually don't think about doing anything yourselves. And unfortunately, it does happen. We do see claims occur, at least 2 or 3 clients every year. I want to share some recent statistics that do tell a bit of a different story in regards to it. If we look here, I won't go through all of them, but some key ones for me are that 1 in 4 Australian women will suffer some sort of cancer in their lifetime. Another point, the third dot point from the bottom. I mean, almost half the population will experience a mental health condition in their lifetime. I mean, that's frightening, that statistic, in my opinion, because look, you know, a lot of Australians are suffering from mental health. It is a very serious condition. And all I'm trying to highlight here to you is that illnesses do occur, and it's just about making sure that, you know, if something does happen to you down the track, I mean, you never know, I mean, what can happen in life. I mean, you look at, there might be a, you know, high blood pressure, stroke, heart attack, or you suffer a back problem. I mean, that back problems account for 40% of forced retirements here in Australia. So it's really important just to make sure that, you know, you understand these things can happen to us, and that you're adequately protected in the event that of anything happening. So again, it's just about making sure that, you know, you consider your own circumstances, because, you know, the worst does sometimes happen to an unfortunate few. So how can you protect yourself and family in the worst case scenario? Look, there are 4 different options really in terms of protection. In short, life insurance, very straightforward. In the tragic event of you passing away, someone is going to receive a lump sum benefit. TPD, in the tragic event that you became totally and permanently disabled, you can receive a lump sum from an insurance company. And generally what that goes towards is paying off, you know, it might be debts or leaving a percentage of your income for your family to continue maintaining their lifestyle. And that's the key thing, again, with insurance. The key thing with it is to make sure that if you can't work again, or, you know, in the event you pass away, your mortgage can be paid off, you can continue your same lifestyle, or your family can maintain their same lifestyle if you're no longer here. Income protection insurance, that's probably one of the more common ones. That just pays you a monthly benefit in the event of you know, becoming ill or injured, and usually will pay you anywhere between sort of 1 year to age 65. And trauma insurance, probably one that not a lot of people have heard of, or the most one, probably out of the 4 of them, the one that most people don't take up because they don't know too much about it, is that pays you a lump sum if you suffered a specified major medical condition such as heart attack, stroke, or cancer. Again, that's there to pay out a lump sum, and usually it's there to help cover, you know, anything which is out-of-pocket costs that aren't covered by your private health insurance or Medicare. So they're the 4 different common options. So there are different options. What's right for me? Look, it's always challenging for us to give you that answer, a definitive answer, because everyone's circumstances are so different. But if out of anything today, if you could just write these questions down and take them home and consider them for yourself. If you became sick and could no longer work, could you maintain your same lifestyle, continue to pay the mortgage? Would you have to borrow from family and friends? And I can tell you, I'm sure that's not going to be a pleasant sort of discussion. Would you have to sell assets? Would you still be able to meet financial goals? Or in the event of you passing away, would your loved ones still be able to maintain their current lifestyle? And especially if you're the main income earner of a family, something for you to consider. And could they stay in the same home? And look, you know, your family would be going through a hell of a time, you know, if anything were to happen to you. So it's important that you probably reflect and go, okay, well, in terms of when you're trying to work out what's the best cover for me and what the right levels are, this is a really good starting point. This is where we start off conversations with clients trying to determine what sort of levels of cover they need. Because as I said, it's really vital that we get the right level of cover. But again, you're not underinsured, or neither you're overinsured, because, you know, last thing you want to be doing is paying too much to an insurance company, you know, when you could be using that money to pay off your mortgage, or, you know, building, you know, superannuation, whatever it may be. But again, they are really crucial questions I'd like you to think about after today's presentation. So look, some examples of when you may need the different types of cover. Look, life and TPD, look, you know, generally most people that take out this sort of cover is if they've got a mortgage, and, you know, if they were to pass away or become disabled, they want to make sure that it's paid off straight away. Other, you know, reasons, if you're the main income earner in your family, you know, would your, you know, family need a percentage of your income to maintain their lifestyle? So it might be 50%, 60%, 70%. But again, these are just examples to help you sort of get a bit of an understanding of where you need to start and when you need to consider your own protection options. Again, trauma insurance have already sort of been over. It's there really to cover you for a short period of time. You know, again, it's in the event of you suffering from cancer, heart attack, stroke. So generally speaking, is those sort of conditions, you know, best case scenario, they only last for, let's say, a short period of time, could be anywhere between a month to 6 months. And look, you know, hopefully you're back at work after that time. But if you don't, generally TPD will kick in, or if it's going to be something even worse, some life insurance companies will pay you 2 years. Like if you've been given a diagnosis that you're going to pass away in the next 2 years, life insurance would pay. But that's just some examples to give you. And look, again, on your income protection insurance, I mean, look, question for you to consider. If you had nothing in place right now, how long does it leave last you? And once it runs out, could you maintain your existing lifestyle? And I think, again, that's a very powerful question, to consider for yourself. How can you put cover in place? Look, there's a range of different options. Most Australians or most clients that we see will have some sort of insurance cover in their super account. You'll probably see it on your annual statement that there's a premium coming out and an expense for insurance. And you're like, would I ever sign up for that? It's just generally when you've started with an employer or part of the super plan, they give you a sort of small amount of cover there. The other ways that you can put cover in place is you can go direct to an insurer. Third option, seeking assistance and advice from a financial advisor. And the fourth, if you're lucky enough, some of you may have an employment situation where there's a group insurance policy there for staff. So, what the benefit is that you may not even know about it, but, it's part of your employment package and the employer's paying for it. And if you would ever go on claim, you'd get paid from income protection or TPD. So one thing out of today's meeting, maybe go back and just check with your HR team if you do have anything in place, because the last thing you want to be doing is having insurance in your superannuation fund, which is dwindling away to super fund when you've already covered through your employer plan. But that's just something to consider there. So I've covered my super plan. So that would mean I have the best cover. Look, it's an interesting question because in our experience, while it is cover, my view is that it's very basic. And it may not be suitable for you. But again, everyone's different. And you've got to be careful too, because if you've had any sort of existing medical conditions and you've already got this covered, maybe the only cover you can get. So, but in saying that too, I mean, when we're giving advice to clients and, we're discussing insurance with them and their needs, we do review what they've got and what we generally find if they do have cover sort of in their super fund or industry super plan, the definitions may not be suitable for you. So a couple of things, if you do questions, you may want to ask your super plan provider, ask what type of definition there is for TPD. It's most likely going to be in any definition because you can't have what's called a known definition inside super any longer. The ability for trustee to change terms. I don't think they can ever cancel your insurance cover. What they can do is sometimes change the terms. Whereas if you went through underwriting and you were getting advice from an advisor or going direct to an insurer, most of the contracts are guaranteed renewable, which means they can't alter the terms while you continue to pay the premiums. Unitized cover, what that effectively means is that the cover will go down as you get older, and I've got a slide to show you after this. And how long does your income protection pay you for? Usually what we find in some of those super plans, it's about 2 years. So this is just an example of when we're doing an analysis between sort of industry super funds and retail insurance policies. Plan A and Plan C is sort of typical industry super fund. They are two major industry super funds that offer insurance. Plan B and D are two major insurers that if you went through underwriting and you went and received advice, went direct to an insurer, these are some of the contracts they can offer. And what you can see here with this independent research is that the core score of 56 to 98 is that the retail provider scores a lot better. Main reason is in terms of the quality of the contract. To give you an example, like in Plan A to Plan B, you've got the ability to work during what's called the waiting period, which means that from the date of your claim to when you'll start getting paid by the insurer. So in Plan B, you can actually work without the waiting period restarting, whereas if in Plan A you went back to work, the waiting period would restart the day you went back to work. A couple of other things in terms of the definition of total disability between Plan A and Plan B, just to give you an example, is that on Plan B it's a little more flexible, being that if you can't do one duty of your occupation, one important duty, you'll get paid, or if you can work less, you can only work up to 10 hours, whereas in Plan A it's all your duties. So you can see there's a bit more sort of flexibility in Plan B in terms of claiming, and that's the key with insurance, is that giving yourself the best chance of going on claim. And generally speaking, the cover inside your super plan might be a bit cheaper, but as we try and highlight to clients that we see, there's a reason why it's a bit cheaper. So it's really about educating you, and that's what we do when we we're giving you advice, educating you on the decisions we're making and how we think making a change will put you in a better position. I did mention before about Unitized cover. This is an example of one particular super plan. What you can see here is that if you were to take up cover, I believe this is life cover, as you're getting older, you can see the level of cover is going up. But when you get to age 40, it starts to decrease. So it goes from 396 down to 391, and then 387, etc. This is Unitized cover. So if you've got cover inside an industry super fund, go and ask the question to the plan if it's Unitized, because what you don't want to get a nasty shock being, well, I've got, let's say, for example, 400,000 of life cover, and then all of a sudden it starts dropping when you really don't need it to drop, because in between these ages of 40 to 50 is when you're sort of most likely to claim and most need your insurance. So it is vital that you find that out from your super plan. But again, we're here to always try and help. So if you've got any questions, we might be able to assist you and at least give you some sort of guidance as to what to ask. Key things you should consider when setting up your cover. Look, these are a couple of my key points. Look, depending on whether you hold your cover inside or outside super, the premiums and proceeds are taxed differently. There's probably too much to go into in today's session, but we would encourage you to have a chat with us, because again, from a tax point of view, making the right decision can make a significant difference down the track, especially when it comes to proceeds, and also in the premiums, because some policies you can get a tax deduction for. There are around 9 to 10 insurers in the market offering cover, so make sure that if you're not going to engage with an advisor, that you do shop around to get the best deal. Be wary of we've already discussed about the cover in your super plan providers. As mentioned, that the terms and conditions may not be suitable for you. So again, I really do implore you to say that if you do have cover in your super plan, do research into it, because it may not be suitable for you. You may get a bit of a nasty shock, at time of claim. If you are to deal directly with an insurance company, just be aware that you may go to one and they may exclude certain conditions, but the others may have a different view on it. So it's important that you don't just, settle for that. Make sure that you do some shopping around there, because they all view risk differently. Look, some other key tips, just make sure with income protection, you check the waiting period and benefit period. Waiting periods usually range from 14 days to 2 years, and benefit periods are from 1 year to age 65. The shorter the waiting period, the more expensive the premium, and the shorter the benefit period, the cheaper the premium. So longer the benefit period, the cheaper the premium. So just be aware of that in terms of when you're setting those up. In terms of TPD, there's an any and own definition. In most super plans, there's an any definition for TPD, meaning that if you can't work in your job to which is suited by education, training, or experience, you'll get paid. However, you can set what's called an own occupation definition, and what that means, if you can't do your current role, you're going to get paid if you're disabled. So that's really important to know, especially for those of you in higher earning jobs, because if you were, for example, let's say a principal accountant and you're earning a significant amount of money now, you may not be able to participate in that role, but they may ask you to go back and be like a junior accountant where you're earning a lot less. So it's really important that if you want to make sure that you get paid, if you become disabled, you're going to get paid, as you're not being able to do your own job, you look at that definition, because in most super plans, it is the any definition. A couple other things, trauma cover can't be held inside super. And again, I just want to reiterate, insurance is not a set and forget strategy. So it's really important that you're taking an active approach with it. Again, right insurance for me, very tough without knowing your personal situation. But again, consider those questions I mentioned to you previously. This will give you a really good starting point. But again, after today's meeting, you can always come and give us a call or send us an email, and we can, provide some general information around that. If you've got any close family members who have suffered certain conditions such as heart attack, cancer, stroke, each condition has a different cost, but again, this is a starting point to consider. So if you know any family members that mentioned that they had to pay extra amount of money outside of their private health insurance covered, this is something to consider. And again, income protection usually covers 75% of your income. Reason 75% is that most insurance companies feel that they're going to pay you anything higher than that. There'd be no incentive to go back to work. And I think the key there is working out what the best waiting and benefit period is for you. Insurance is expensive, so will the cost be worth it? Look, in short, our experience is that not having the appropriate cover will cost you more in the long run. I mean, really, all you need to do, I think, is picture yourself waking up tomorrow and not being able to earn an income. Could you maintain your existing lifestyle? And again, if the answer is no to that, do something about it. go and have a look. You don't necessarily need to speak with us. We encourage you to, but if not, think about your own circumstances and run those hypothetical questions we shared in the previous slide. In our experience, the cost of cover over the long term won't have a significant impact on your wealth goals. And when we're putting together a wealth plan, we show you the difference to what having cover in place and paying the premiums is going to do in the long term versus not, but also showing you a stress test to say if you didn't have cover, we couldn't achieve when you wanted to retire, you couldn't pay off your mortgage when you wanted to, help the kids, whatever it may be. So again, in our view, I think that if you do need the cover, the cost of not having it is worse than paying for the premiums in the long run. A lot of people get concerned about if insurers will pay if you go on claim. What we can tell you from statistics released last year by the Financial Services Council, 12 billion was paid out to 101,000. But if you look at the statistics, 97% of death cover claims were paid, 90% of TPD, 95% of income protection, 86% of trauma. So I know that insurers have got a bit of a bashing from the press in recent time, but you can see here from the statistics, more than the majority of claims do get paid. So we do hear that concern sometimes from clients, but just want to put the statistics out there to show that they do actually claim. How much does it cost? Well, it's always very tough to determine, but look, it all comes down to levels of cover, age, smoker status, your occupation, because, white-collar workers generally is not as high a risk as blue-collar workers. But again, look, shop around on the premium side. There's wealth of knowledge out there in terms of getting premiums and comparisons. So, but again, it's very tough to tell, because everyone's circumstances are so different. When to speak to a financial advisor? Look, my 5 key points in terms of when to speak to an advisor, because if you are looking to set up insurance, it can be time consuming, and I can tell it is very complicated. I mean, I've had years of experience of doing this, and I'm still seeing things that I haven't seen before. So look, if you really want to do it properly, it's going to take a significant amount of time. It's not just a couple of hour things, it's days, it can be weeks. So if you don't have the time to be dealing with insurance, come and speak to an advisor. If you don't fully understand the taxation implications of claiming on your insurance policies or the premiums you pay, again, that's really critical, because if you make smart choices now, it's going to be a lot better down the track, especially with the fact that you can claim on certain premiums for income protection. For income protection, you can claim on the premiums for that. But there's certain other insurance policies there that, depending on how it's structured, whether it's inside super or outside super, the taxation treatment's different. If you're not quite sure how much cover you need and the different types of insurance cover you need, that's another reason to come and chat with an advisor. Have the time to be reading all the terms and conditions of the contract. PDSs can range between 60 to 200 pages. So it's really important if you don't have the time to be doing that. Again, that's another probably reason to come and speak with an advisor. Or if you have the time to calculate how the cost of cover is impacting your wealth plan. So I'd say they're probably the 5 main reasons of coming to see an advisor. So with that said, some action items I want you to take out of the presentation, because I'm just wary of time right now, is that, consider if you need to protect yourself. I think we've given you probably enough in terms of questions, but again, these slides will be available for you. If you answered yes to the above, review your current cover, what you've got inside your industry super fund, or whether it's you've gone and set up insurance quite some time ago with an insurer directly. And then after reviewing current cover, and if you're unsure if it's still appropriate for you, please feel free to contact us, because we are here to help. And we want to make sure that we can get to as many people, because we have seen in the past where people haven't had adequate cover, and it's been very challenging conversations with them about what they can do going forward. And again, it isn't pleasant. So again, look, I really implore you to just, after today's presentation, is to go back, consider your own circumstances, and again, if you've got any questions, please feel free to contact us. But with that said, I believe it's now time for some questions. So I'll open it to the floor, and yeah.
All right, perfect. Thank you very much for that, Chad. Now, what we might do, I can see I have about 3 people who have asked very similar questions, so I'm just kind of consolidating it into a one-liner for you. But the question is, can I get insurance if I have had a major medical condition previously?
Okay, so the answer to that, it's a tough one to answer, but that's why we'd probably encourage you to either come and chat with us if you can. Reason I say that is that all the insurers, you may recall previously in the presentation, all the insurers take a different view with certain conditions. In most cases, you would still be able to get cover, but you may have what's called an exclusion, which would mean that if you were to go on claim, the insurance company may not pay you that, if that major medical condition was the reason for you going on claim, but they would outline that to you at the start of the contract to say, look, we're happy to give you cover, but before we get your approval or we sign off on it, we need you to accept that there'll be an exclusion on the policy. So some may also put what's called, Siobhan, a health loading on there on the policy, which means that the premiums may be higher than what you would get at market, and that's just for them to cover the extra risk. But in summary, you should be able to get cover. It just may be an exclusion on the insurance.
All right, perfect. I think that that covers it. Now, look, there are a few more questions here, but being wary of time, we might wrap this up. We'll get back to each of you individually after this. Now, look, as Chad mentioned, these slides will be available to everybody, and we'll also send out a recording. And there might be some people that you want to pass that on to. They were unable to get to the presentation today. But next month, again, I encourage you to register. We do have the 5 lots of $1,000 to give away to the charities, but we've also got our managing principal, Ian George, who will be presenting for us next month. And look, he'll provide a summary of all the webinars to date, which will cover the stages of the financial life cycle, the importance of planning for wealth accumulation, tax, as well as insurance. And look, guys, we'll get that invite out to you in the next couple of weeks. If you're unable to join us, please reach out for a copy of that recording. But if not, I wish you a very Merry Christmas and a Happy New Year. And I enjoy working with you. I look forward to working with you guys in the new year. Thanks very much.